Hello everyone, welcome back to our episode of Ground Reality. Today I'm gonna talk about two very interesting and two of my favorite topics or items you can say. So of course being into real estate, real estate is what I like and I have most interest in, especially in home loans and residential real estate. So that's one of my favorite topic, and I discuss that with clients on a very regular basis. Interestingly, the second thing which I'm going to touch upon today, and I'll use that reference, is the new trend ghee coffee. I'm sure you all must have heard about ghee coffee. It's the in thing, a lot of people are trying it, and it is coming across as a very good thing to drink in the morning, especially for energy and for freshness. I'm consuming ghee for like childhood. From I belong to a traditional joint family. I was born and raised in a joint family, so I am consuming ghee from childhood, and of course, I didn't know about the benefits or side effects of that, but it was given by the family members, and it was good. I had a taste for ghee. I was not a coffee person for a large part of my life. I met coffee in the canteen of college, and slowly, I developed taste of coffee. So I am consuming ghee and coffee for long. But recently only I stumbled upon this new thing which is happening, which is a combination or merging of both the things. I was really surprised initially, and I was very curious, what is this and how it will taste. I have no idea. Interestingly, what has also happened is, and just to qualify, I was not a gym person for a large part of my life. I never used to go to gym. For exercise, we used to play sports in school and colleges, and generally after work, I used to do walks and all that. So I never went to gym. But then, off late recently, I think just 2.5 years back, I started going to gym. I joined the gym because my wife told it's better to be the oldest in the gym than the youngest in the hospital. So it that triggered, and it was a stark statement which she told me. So she literally pushed me to go to gym because I was having health problems. I'm gaining a lot of weight and all that. So there also I saw a lot of people, actually people who are high into fitness, and they are actually very into fitness. They are taking care of their fitness for long. They spend number of years in fitness, and they also when interacted, they also gave the same thing, and they drink caffeine in coffee, which is very good for fitness and strength and stamina. So I stumbled upon that. And then when I was thinking, I think last week sometime we were discussing about a loan transaction for one of our client. For strange reason, I kind of thought of maybe similarities between, let's say, how a ghee coffee works for a person versus how home loan works for acquisition of home loan. So I thought, why not? And it looks interesting. I discussed with my marketing team, and we really like the idea. So we thought we'll take inspiration from each and see how we can correlate and explain the thing. Of course, home loan is not a new thing. Everyone knows about home loan. Debt and real estate is not a new thing. Similarly, coffee is not a new thing. Ghee is not a new thing. But probably when you put everything together and try and contextualize, probably you can take good inferences from it. You can take good inferences from it, or you can take out good points from it. So what I thought, let's start from the beginning. Let's say, what is ghee coffee? So basically, you have a small spoon of ghee, like 15-20 grams, and you have a small teaspoon of coffee, and when you merge it and you actually make a rich texture of it, that is what I say I can relate to is as your equity, your hard-earned money. So we all are working hard, and you were making money, earning salaries, taking care of our families, our day-to-day needs. Then we have some surplus money, which is our equity, which is what we love, which is like very rich textured. Money is always rich textured. It looks very good. When you see currency, when you see the number in your bank account, looks very good. You feel happy about it. So it's a very rich thing to see, like rich textured coffee. So coffee and ghee texture is very good. But then, of course, you can't drink that alone, right? You can't be satisfied with just one table or 2 tablespoons of ghee and coffee concoction or mixture, you can say. What do you do? To make a full cup of coffee, what do? You pour some hot water in it, right? So to make it comprehensive, to make the full cup of coffee, you have to add water. Water can be multiple of like 15-20 times of the mixture what you made, right? So that is, you can say, leveraging the strength of the texture or the mixture and making it something which you will love and you will take it. Water doesn't dilute anything. It enhances the taste. It takes away all the characteristics and properties of that mixture of ghee and coffee. Similarly, when you have your hard-earned money, your equity, your money which you can use to pay to buy a property, that's very, I'll not say very small, but that's limited, right? You can't buy a decent property or real estate only because of your equity in most of the cases. Of course, they are good performers, people who have a lot of money, they are making money in first 3-4 years, 5 years also, they can put all the money and buy. But I'm saying majority of the people, they have a handsome chunk of money with which they can buy, but they need some help in additional funds. So how to do, how to leverage it? It depends, so if you look at data, and we have also seen in India, typically the property price to the annual salary of a standard person is in the multiple of 4.5 to 5. What it means is, if you pay 100% of your salary, full salary towards home loan or buying a property, it will take 5 years to buy the property, assuming 100% of your monthly outflow is going towards the property. 60 months, you can say. But then, of course, it's not possible, right? You need money for other things also. So as per trend, as per a lot of data, as per a lot of research, a lot of practical things, people generally keep 25 to 30% of the salary for home loan acquisition or real estate acquisition. So it's 1/3, right? So then your tenure increases from 5 years to 15 years. So instead of 5 years, you'll be able to own a house in 15 years if you pay the 30% of the salary towards the real estate. But then, of course, there is a compounding effect, there's an interest cost attached to it. So when you're taking a home loan, there's an interest component or borrowing cost. So what it will do is it will make that 15 years tenure, so 20 years, it will add another 5 years or 6 years. So in majority, you can say 95% of the cases, probably families buy a home loan, they take home loan, they buy properties with the home loan tenure of 20 years. And they get a multiple of around 4.5, 5. So whatever CTC they are getting individually or collectively, they multiply by 5. That's affordability. So let's say family income is 20 lakhs a year, so they can easily afford a home which is valued at around 1.1 crores or so, right? So that's a standard thing, I'm sure everyone knows. Now going back to the comparison between, let's say, a ghee coffee and a home loan, many people may have more money, right? Of course, you have saved more money, you're working hard, you've made more money. What happens is, sometimes you may think, I can pay more equity and take less loan. Because traditionally, as per our, family things, I was always told from childhood, debt is bad, loan is bad, we should never take loan, we should only save money and buy the house at the end of whenever we have money, whether it's the age of 45, 50, 60, even after retirement, that's okay. So we always were given that inputs. We never thought, that can be good or it can be useful. I'll not say good or bad, but useful. It can be useful if you use it smartly, right? So I'll give you my personal example. When I was buying my first home, then I was buying and my friend was also looking to buy. We were buying, scouting properties together. So we found one property, one apartment complex where a 2-bedroom was available for 40 lakhs and a 3-bedroom was available for 55 lakhs. So, and me and my friends were earning almost similar salaries. Our income level was similar, and we were at same stage. We just got married, and both of us had one kid. So, my friend had a bigger risk appetite. So, what he thought, he'll take 3-bedroom. He booked 3-bedroom, 55 lakh rupees. He took a bigger loan. The amount of money which he put and I put was same. The amount of equity contribution done by him and me was same. But he took a little bigger risk and he bought a 3-bedroom apartment which was costing 55 lakhs. I bought a 2-bedroom apartment which was costing 40 lakhs. And I was very conservative, you can say, because of maybe you can say family upbringing or the kind of things we were doing. Down the line, after 10 years, when he sold his house, he sold because he moved to a different city, his 55 lakhs became 1.5 crores. My 40 lakhs became 85 lakhs. See the delta. So the huge difference, the 15 lakh gap became 65 lakh gap. He used the leverage. Even if you net the interest cost, the delta of him was much higher than what I made. That was big learning for me. I mean, I realized that, okay, maybe I was a little more conservative. Maybe we should do more smart use of the home loans. Like, going back to the coffee, if you have little more coffee, little more ghee, you don't put 2 spoons of ghee and 2 spoons of coffee to make 1 cup of coffee, right? Because the margin and utility of incremental consumption is not much, right? Whether you put 1 spoon or 2 spoon, it will not double. If you put 2 spoon or 3 spoon of coffee and ghee, it will not triple your energy levels. It doesn't work like that, right? You have extra energy, but it's not double or triple. So the margin and utility diminishes with the consumption. Similarly, the margin and utility of your equity or contribution towards your home, the impact decreases. Whether you're taking 20% home loan, 30% home loan, 50% home loan, the more you put the equity, the impact of equity diminishes. So what do you do? Basically, I had this discussion with many clients. People, just if they have extra money, they just want to buy home and just keep it safe, and they're saying, okay, it's my house, I have less this requirement, I don't want to pay EMIs. Valid point, of course, I don't argue that. But then the point is, what do you do with that extra money? So if you put 2 or 3 spoons of ghee and coffee in ghee coffee, probably the taste may not change drastically. You may not get multiple energy. You can make 2 or 3 cup of coffees or tea with that, right? Or you can make extra 2 or 3 cup of ghee coffee. Probably you can sell it or give it to your friends, right? From business perspective, you can sell it. So you can sip 1 cup and you can sell 2 and make money. Similarly for real estate also. For example, if you are looking at buying a property where you have 40% of the money, 40% of the property price is equity with you, I will personally advise, or I will give you a scenario where instead of buying 1 property, you can book 2. And I'm telling this scenario when the property you're booking is under construction or at launch stage. See, there are 2 kind of home loans in real estate. One is you're buying a ready property where you're putting everything upfront. Your loan 100% is disbursed. Like you're buying a 1 crore property, you're putting 20 lakhs, 80 lakhs is disbursed immediately because the property is ready. And you start living there. That's a consumption. I'm not talking about those things. That's a different scenario. I'm purely talking about investment scenario where you're looking at investment and taking advantage of debt. So if you are buying a property which is at launch stage, typically what we have seen is from launch stage to sustenance, which is like maybe next 1.5 years, to delivery, which is around 3 years, you can say 3.5 years. So 3 stages are there. So launch stage, sustenance stage, delivery, which is ready to move in. At the launch stage, you get the best price, right? So at that price, whatever you have, let's say you have 40% of the equity, the house value. So you don't have to take any loan for next 1.5 years till sustenance, because normally they take 10%, 10 installment of 10%. So 20% you have to book, pay at the time of booking, and then every quarter or 4 months they raise demand for 10%. So typically it will take around 10 to 11 or 12 quarters to complete the payment. So if you have 40%, you don't have to take any loan for 1 year, right? But then you're putting your own money. Instead of that, if you booking 1 flat, you book 2 flats, maybe smaller size, little smaller size also. You will be able to afford that based on the loan requirement and your eligibility. If you do that, and if you do the maths, if you do the calculation, at the end of, let's say, 3 years when the property is ready, typically we have seen from launch to 1.5 years, there is a delta of around 10 to 15%. Builder developers, when they launch, the price is lowest. As and when the units are getting sold, the inventory is getting sold, they increase the price. Of course, that's how the model works. So they increase the price by 10, 15, 20% till sustenance stage. And the price is increased drastically towards the delivery because the property is ready. So by that time, the delta is upwards of 40%. In good projects, I'm saying, not all. Good projects, good developers, good location, the delta can be 50, 60% also. We have seen enough cases like that. Of course, if you look around, you'll find many cases, use cases where people have done that. You've seen appreciation in properties in 3 years from launch till delivery with a delta of 45, 50%, sometimes 60% also. It may happen in some cases. I have heard, of course, we know where the developer has gone bankrupt, or there's some issue with the developer, may not be a professional developer who has not delivered the project. So those are different cases. So we don't advise on those developers. I'm talking about a specific scenario where you are actually buying a property in a good developer project, in a good location. A developer have a good track record. He's delivered multiple projects on time, has a good reputation. So assuming those scenarios, of course, there will be a delta of, let's say, launch to delivery 45-50%. If you have taken a home loan 20% is your equity, 80% is your home loan. Of course, the disbursement doesn't happen in one shot during construction. As I mentioned, you have to pay 20% now from your pocket when you are booking at the launch stage. First 4 to 5 months, 6 months, there is no other demand. After that, the first demand will come, then your home loan will start disbursing. So what happens, your disbursement happens 10% in strata of 10% every 4 5 months, 6 months or 3 months, whatever the schedule is. So your interest payout, only the interest you pay during construction, interest payout increases slowly. You don't pay interest on full loan amount, only the amount which is disbursed you pay. So I think if you look at that number, I know I'll give you a different context here. Let's say someone is selling a property, launch price is 6,000 rupees square feet. Many times builders or developers will have a tie with the funding institutes where they will say, okay, you pay 10% now, 90% of the possession because the bank will take care of it. It's a tripartite agreement. So in that case, the pricing is increased by 600 or 700 rupees a square foot on a base of 6,000. So you can say 10% to 15% extra. So what happens, that is only to take care of the interest. Of course, no one will pay interest on your behalf. So developer will also charge it. He'll increase the cost price. But then it is taken care. So if you look at the delta, if the price is increased from launch to delivery by 40-45% and you're paying interest which is hardly maybe 10 to 15%, you still have a delta of 25%. 25% delta. So I have seen cases where people have paid 20 lakhs and book a 1 crore ka flat, and when the property was ready, they didn't register, they moved out, they sold it. And at that time the price was 1.3, 1.4 crore. So there was a delta of 40 lakhs, but they have not paid 40 lakhs, they have not paid 1 crore. They paid only 20 lakhs and the rest is loan. The interest also is nominal, right? So you can say the interest over that period was probably 10 or 12 lakhs. Still they have a delta of 15%. So 15% or 15 lakhs. So if you look at it, by investing 20 lakhs, they have made a profit of 15%, 15 lakhs. Actually, it's 75% return, right, on an investment because they have not paid any money from that start. The maths work like that. So if you look at smart investors, there are a lot of people who have cracked this code. It's a hack they've learned. They're doing it. They do invest at launch, they exit at the delivery, and they make profit out of the delta, which is from launch to delivery. So I will like to say debt is not bad, but the way you use it. I'm not saying blindly book anywhere and just pay, book 5 flats, 3 flats, 2 flats and all that. Do your research, no problem. You do research, take your time. There are projects getting launched every quarter. It's not like project will not launch next quarter, next year also. You do your research, you do see where the properties are getting launched, which the area, where the action is, where the movement is happening, where the companies are moving, where the economic activity is moving. Look for that area, look for a good developer, look for a good deal, then do that. But use leverage of debt. Debt is not bad. I mean, what we were told. I have seen enough cases, my personal experience also. I actually lost opportunity because I was a little conservative. But then, I've learned this hard way. Now I don't do that. So I advise clients, if there are possibility of having an extra equity, leverage it. Because as I mentioned, the margin and utility of equity consumption in the project is less. Ideally, you should put 20-25% or max to max 30%, not more than that, and the rest should be leveraged in the under construction property. It will probably give you a leeway because, as I mentioned, normally 30% of your salaries are towards the EMI calculation. You should also keep some 5 to 10% as a saving or for emergency in case you need to have that fund for something related to property or something related to your personal thing. So if you keep that delta, I think equity will be very, very carefully crafted and invested. Equity is very critical, like the texture in coffee and ghee. So of course it's harder, we love, but then what happens, in that context, if you look at, the more you put water absorb that texture and that taste and that color of ghee and coffee, and the full cup became like that. So over a period of time, like it happens very fast in ghee coffee, but it takes whatever, a couple of years where your equity absorb the home loan, right? It becomes your asset. Of course, you are paying slowly. Similarly, it is getting absorbed slowly. So if you look at this, now it is absorbed. So ghee, the full cup is ghee coffee. You can't extract ghee and coffee out of it. It's full ghee coffee. It's really tasty. Yeah. So coming back, my idea of telling this thing was to give in perspective. Uh, of course, you will get advice from friends and family saying don't leverage in bad times. It may affect you. There are many cases, people have suffered because of debt, but then probably it was not the debt which was bad. Probably it was the selection of the asset which was bad. It can happen with any asset, right? I mean, if you're buying a luxury car, and the car, of course, the automobile or any other assets will decrease or depreciate, it can happen in that also. I know so many cases where people have booked like BMWs or Mercedes or whatever cars, and because their financials didn't work out the way they planned, they have to actually sell that car at a much lower discount, and then they have to adopt a smaller car. So it depends. But in properties, at least the advantage is you don't have to budget depreciation. Worst case scenario, you'll get back the money what you invested, right? Of course, there are few cases where the property is so bad, or the location is so bad, or the builder is so bad, you may have losses. You have to cut losses, you have to write off the thing. But most of the cases, if you do little research, you do smart investment, I think that is good. The way it works, you have to do your maths. You have to know your CTC today, your projections of your income for next 5 to 7 years, 10 years. Of course, we take home loan for 20 years, but no one actually wait for 20 years. Everyone I've seen, they actually close the home loan within 5, 7, 8, 10 years, max to max 10 years. No one keeps a home loan after 10 years, because home loan is given for 20 years based on the income of year 1. Of course, people earn more, they get an increment, they change job, their salary increases, their income increases. So probably that tenure gets shortened from 20 years to 10 years. So real estate, if you do proper planning, if you use the equity, your hard-earned money wisely, and right mixture of debt and equity, it will give you fantastic returns. So I hope it was useful. I tried covering this topic because so many people ask me about the calculations. We are planning to do another round of a small clip where we can show how to calculate the home loan, and the calculations we'll put in Excel and we'll show and put it probably in some time. But that's a very interesting thing, and it's very good. Now more and more clients and more people are coming openly discussing these things. Earlier, there was a taboo. People don't used to discuss their financials. They used to feel bad. They used to think, why should I share my income or my limitations or my inability or ability to buy properties? But now people are much more open. They openly discussing with us. Earlier they used to discuss only with banks, but now of course we also help because we know this thing. So we try and give them right information. There are a lot of different offers and schemes which are available even from banks, new age banks. There are a lot of new fintech companies who are giving fantastic offers. So I'm definitely looking forward to your queries, and if you have anything, I'll be happy to help. We have our own set of connects, and we have our own tie with good financial institutions where we help our clients in probably bridging the gap of loan. And any query, any questions, please feel free to put in the comment section of YouTube. It was a quick thing, hope it was useful. Thank you and have a nice day.